Let's talk about currencies. Many Harvest products, like the Harvest Tech Achievers Fund, HTA, are offered in multiple classes: Class A, Class B, and Class U. An investor can choose between the three for their preferred type of currency exposure. Class U is probably the easiest to understand. HTA Class U trades on the TSX using US dollars. The distributions are also paid in US dollars. The Canadian dollar plays absolutely no role in a Class U unit of an ETF. A hedged ETF, like HTA Class A, is priced in Canadian dollars, and it is little impacted by the USD-CAD exchange rate. If the underlying stocks in HTA are up 5% in aggregate, then the Class A ETF will also be up roughly 5%, regardless of how the USD-CAD exchange rate is moving. Of course, it is impossible to be perfectly hedged at all times, so there's still some small amount of currency exposure. What about an investor that wants full currency exposure? They should consider Class B units, like HTA Class B. These ETFs combine the effects of underlying stock movements with the movements in the USD-CAD exchange rate. If the US dollar strengthens against the CAD and the underlying stocks appreciate in aggregate, then a B-class investor will realize amplified returns from the combined effects compared to an A-class investor. On the other hand, if the US dollar weakens and the underlying stocks coincidentally depreciate in aggregate, then a B-class investor will experience amplified losses compared to an A-class investor. Consider a scenario where punitive tariffs are imposed on Canada. This could cause the US dollar to strengthen against the Canadian dollar. Over such a period, a Class B investor of HTA might get a higher return than an A-class investor of HTA, simply due to the US dollar's increasing strength. I hope this explanation was helpful. Thank you, and have a nice day.